In this final section of the Chapter 1 material, we'll discuss the primary goals of businesses and the types of businesses that exist outside of the United States. There are a lot of potential goals of a business. A corporation could focus on maximizing profit, minimizing costs, increasing its market share, or supporting social causes. However, because a C corporation is owned entirely by shareholders, the goal of a firm should be to maximize the value of the firm to the shareholders. This means that a CEO should always focus on actions that maximize shareholder value. The market value of a firm's stock is the price that the shareholders could sell their shares for today. It is different than the book value of equity listed on the balance sheet. Now, the market value of a share of a publicly traded stock is the price per share listed on a stock exchange. The reason management's primary goal should always be to maximize the market value of a company's shares rather than focusing on some of the other potential goals I've listed here is because the CEO and the other members of the management team are employed by the shareholders and tasked with maximizing shareholders' utility. This is generally taken as maximizing the value of the shareholders' shares. Some other potential goals, like cutting costs or increasing market share, could benefit shareholders, but these actions might not necessarily increase the value of the firm's shares. For example, a CEO might cut costs today, but this could damage the long-run viability of the firm because the firm is not investing enough in research and development. If the firm is not able to compete in the long run, then shareholders would not be able to sell their stake in the company for as much as they would if the firm was financially sound in the future. As we'll talk about later in this course, the value of a share of stock is based upon the discounted future cash flows the owner of the stock could receive by owning that share of stock. This means that the goal of a CEO or financial manager should be to increase the future cash flows of the firm that can accrue to the shareholders if they want to increase the market value of the stock. Some firms have secondary goals. For example, when Ben & Jerry's was first started, the owners wanted to also benefit their local community and use socially responsible ingredients. The problem with goals other than value maximization is that often there are shareholders who do not believe in the secondary goals or are only interested in earning a high return on their investment. There is also the issue that a firm is competing with other firms whose sole focus is likely value maximization. If one firm is socially responsible but inefficient, while their direct competitors are not socially responsible yet more efficient, the competitors could drive the socially responsible firm out of business. This is one reason why firms should always be wary and make sure to maximize shareholder value. So you might be wondering how we actually determine the value of a share of stock. We determine how valuable a share of stock is by calculating the present value of all of the future cash flows you are expecting to receive by owning that share of stock. We do this using the model I've shown you right here. The model you see is a basic variation of the time value of money formula, which is, as you'll see in a couple of weeks, the most important formula in the field of finance. To value a share of stock, we estimate the cash flow we will receive at each point in the future. Then, we discount each cash flow to the present to account for the fact that we are unable to invest the money we spent on this share of stock for a certain period of time. The amount we discount our cash flows by is called the discount rate. In this case, our discount rate is an interest rate. You can think of a discount rate or interest rate as the compensation for you giving up your ability to use your money for a certain amount of time. We sum all of the discounted cash flows up to calculate the intrinsic price of a share of stock. This intrinsic price is the price that this share should be worth based on the expected future cash flows of the firm. If the current market price of this stock is higher than the intrinsic price we can calculate, we might want to buy shares of this stock. There are a lot of factors that affect future cash flows. For example, lawsuits against the firm might lead to a decrease in future profits and cash flows to the firm. This is one reason why management usually acts in accordance with the law. Decreased future sales might also decrease future cash flows, and thus the intrinsic price of the stock. Using this model, we can also see that when a firm gives cash to charity, it will have less cash to pay out to shareholders in the future, which decreases the value of the firm's shares. In the denominator, an increase in the rate at which we discount the cash flows will decrease the value of the shares. There are lots of factors that could increase our discount or interest rate. For example, if the firm we've invested in is close to bankruptcy, banks might only lend to the firm in exchange for a very high interest rate. Using this model, hopefully you can see why we care so much about cash flows in finance. Expected future cash flows determine the underlying value of every asset in finance. Now let's take a look at an interesting problem. Let's say you used to manage a company you own, and let's say it's a Scotch distillery. On December 31st of 2014, the company was worth $1 million. You decided to step away and travel, so you hired a manager who likes to take long vacations and neglect his responsibilities. A year later, the company is only worth $750,000. What kind of problem are you facing? Well, since I put the answer on the slide, this is probably not a difficult question to answer. In this example, you're facing what's called an agency problem. An agency problem occurs when the interests of a principal, in this case you as the owner of the distillery, and an agent, in this case the manager, are not aligned. Although you're paying the manager to operate the distillery, they might also derive benefits from being lazy. If you have not properly incentivized them to maximize the value of the firm, then more often than not, they're just going to act in their own self-interest and enjoy themselves while still drawing a paycheck. You can have agency problems in many situations outside of business. The classic examples we use in business are the agency relationships between shareholders and the board, or board members and the CEO, since board members actually hire the CEO. In any agency relationship, a principal hires an agent to represent their interests. However, agents tend to act in their own best interests rather than the best interests of the principal. The cost the principal suffers when an agent does not maximize the principal's value is called an agency cost. An agency cost is often not observable, so we often say that it is an opportunity cost, or the cost of a missed opportunity. In the case of our example, the agency cost is the difference between what your firm is worth now, i.e. $750,000, and the value it could have been worth if it had been managed properly. There are many classic ways to reduce, but not completely eliminate, agency costs. The board of a firm can incentivize management to maximize firm value using stock options and bonuses tied to profits. Both of these can have unintended consequences if the manager decides to quote-unquote game the system for their own advantage. Another method for reducing agency costs exists in the corporate control market. Stockholders technically have control of the firm and, if dissatisfied, can oust the management via a proxy fight or a takeover. However, this is easier said than done. Staggered elections for board members often make it difficult to remove the board that appoints management. Poison pills and other anti-takeover mechanisms make hostile takeovers difficult to accomplish. Occasionally, a hostile takeover occurs when a firm has very ineffective management. A hostile takeover occurs when an outside investor lobbies the shareholders of a public firm to sell their shares at a premium. Once the hostile investor buys enough of these shares, they can replace the board members and force the board and the management to agree to sell the remaining shares of equity. One of the primary roles of the board of directors of a corporation is to oversee, hire, and fire management when needed. If a manager is performing poorly, the board can threaten to fire or actually fire or replace the management. One other method to reducing agency costs is to take cash out of the hands of management. There are many firms in existence today that have a large amount of cash on the balance sheet. For example, Apple, Google, and Berkshire Hathaway each have tens of billions of dollars in cash. Unethical management could use this cash for their own benefit or for selfish reasons such as buying a corporate jet, acquiring a prestigious but overpriced asset or company, or simply increasing compensation to their loyal subordinates, regardless of the performance of those subordinates. The boards of many firms institute dividends to take cash out of the hands of management and return it to shareholders in order to ensure this kind of practice is minimized. There are other tools that the board can use, such as requesting the management lever up, aka borrow money from a bank or other investors, and the interest payments to the bank or to outside investors will decrease the amount of cash on hand available to management. In addition to management being lazy or taking pecuniary benefits for themselves, there are some cases of fraud by management and board members. Back in the late 1990s and early 2000s, there were many accounting scandals driven by corporate greed. One of the most famous corporate scandals was that of Enron. Enron began as a natural gas company, and over several decades of acquisitions and mergers grew into a multi-billion-dollar firm that transported natural gas through pipelines in the southern United States. In 1985, a man named Ken Lay became the firm's CEO. He changed the firm's name from HNG Internorth to Enron. Over the next several years, Enron changed its core strategy from transporting and selling natural gas to using the firm's insight in the pipeline business to make large amounts of money in the futures market, since Enron had profitable information about the supply and demand of natural gas. During the 1990s, Enron also began to use what's called off-balance sheet partnerships in order to hide the debt the firm had borrowed in order to finance its operation. The firm also began to diversify into industries and countries where it did not possess a competitive advantage. Enron's fall eventually came in the early 2000s as investors began to question the accuracy and legality of the firm's financial statements. Much of Enron's debt was not reported on its balance sheet, and much of its profit and assets were actually just fictitious. Amazingly, Enron's CEO and other senior management claimed to not have any knowledge of any misdeeds. As a result of this scandal, Jeffrey Skilling and Andrew Fastow, Enron's COO and CFO, received a total of 8 years in prison. Ken Lay, the CEO of the company, died before he could be sentenced. Both Enron and the firm's external auditor, Arthur Andersen, filed for bankruptcy. The larger fallout from this scandal came in the form of new legislation called the Sarbanes-Oxley Act, or SOX for short. SOX implemented new accounting practices. For example, now both the CEO and CFO of a public company have to sign off on the firm's financial statements before they're submitted to the IRS. This new regime is viewed as costly to firms, which has led several firms to go dark, aka become private companies when they were previously publicly traded companies. The management of Enron lacked business ethics, which is generally referred to as a form of professional ethics that governs how an individual addresses moral or ethical problems in a business environment. However, Enron was not the only case where management lacked business ethics. There are many firms in existence today that lack business ethics. For example, in the past, some stockbrokers have been known to convince their clients to buy and sell shares when it was not in those clients' best interests, in order to increase the compensation or commission of those brokers. There are several pieces of legislation that attempt to reduce violations of business ethics. One that I should mention, since it's a hotly debated topic today, is something called the Volker Rule, which was included in the Dodd-Frank Act. The Volker Rule is a federal regulation that prohibits banks from conducting certain investment activities with their own accounts. It limits their ownership and relationship with hedge funds and private equity funds. The Volker Rule's purpose is to prevent banks from making certain types of speculative investments that contributed to the 2008 financial crisis. While financial professionals only need to follow the letter of the law in order to remain out of jail, there are several professional organizations, such as the CFA Institute, that mandate that their members act according to the group's ethical standards or risk losing their certification. The final topic I wanted to mention related to ethics is corporate governance. Corporate governance refers to the mechanisms, processes, and relations by which corporations are controlled or directed. Firms with good corporate governance are able to effectively incentivize management to act in the shareholders' best interest. In fact, financial research has shown a strong positive relationship between corporate governance and many valuation metrics. There are many examples of what constitutes good corporate governance, but I've listed some of the most common ones up here. First, firms whose board members are independent, aka not also managers of the firm, are more likely to disagree with the CEO when that CEO makes a poor decision. Second, firms in which the CEO is not also the chairman of the board are said to have more effective control over management. This reason should be fairly obvious. If the CEO is also the head of the organization that is supposed to be overseeing his or her actions as the manager, it's unlikely he or she will be fired for poor performance. We also know that firms that have more frequent board meetings and greater board diversity in terms of personal backgrounds are more likely to be valuable, since there is more critical discussion during board meetings. There are a variety of ownership structures outside of the United States. One of the most common is the PLC or SA. PLCs are the British equivalent of the C Corporation. These firms are publicly traded and offer their investors limited liability. SA, or Société Anonyme, and please excuse my French, are corporations in countries that use civil law rather than a common law code which is used in the United States and Britain. These firms are equivalent to a publicly traded firm in Great Britain or the United States. An SOE, or state-owned enterprise, is a firm whose majority shareholder is a country. For these firms, the goal of the firm might not be maximizing shareholder value, but rather achieving some additional goal of the country. For example, in China, many of the largest firms are considered SOEs. While there is a value maximization goal, these firms often employ far more people than necessary to run the business. The reason they do this is to ensure that these people have a job and an income. This goal is at odds with the shareholder value maximization goal. The most well-known SOE is Saudi Aramco, which is the firm that owns the Saudi oil fields. This firm has been known to build schools and roads in Saudi Arabia, which benefits the state. An industrial group is a broad phrase for a group of companies that are owned by one individual or a group of individuals. The most well-known examples of industrial groups are likely the South Korean chaebol. The largest chaebol is Samsung, whose revenue is equal to approximately 17% of South Korea's GDP. Although there are various legal entities under the Samsung umbrella, the largest shareholder is the group's founding family. Finally, a multinational is any firm operating across international borders. There are a lot of other business forms. For example, in Germany, GmbH is a common acronym after a corporation's name. I'm not going to try and pronounce that acronym just because I already know I'm going to fail. Most Western countries have some corporate form similar to the C Corp or LLC. I've listed some of them here. So let's recap what we covered in this chapter. First, finance is intertwined with most operations of a firm. Therefore, it's necessary for everyone studying business to have a good grasp on basic financial techniques. Next, there are 4 broad areas of finance: investments, corporate finance, financial services, and financial markets. We also discussed the basic corporate forms, including sole proprietorships, partnerships, corporations, and LLCs. We also discussed why corporate governance is necessary for any firm to meet its goals. Finally, we explained why the goal of most organizations is to maximize shareholder value.